You know, people love to complain about taxes. They curse at the government, blame politicians, and insist that the deck is stacked against them. But here's the uncomfortable truth, the kind of uncomfortable truth Charlie Munger specialized in exposing. Most people don't lose money because the tax system is inherently evil. They lose money because they never bothered to understand the rules of the game they were forced to play. Taxes will likely be the single largest expense of your entire life. Think about that for a moment. They will cost you more than your home, more than all the food you eat, and more than all your healthcare expenses combined. Munger, Warren Buffett's brilliant partner, had a term for this passive, costly oversight, the unforced error. He often cited specific financial habits that cost the middle class hundreds of thousands, sometimes millions, in tax-free profit. You have been conditioned to think of taxes as a fixed bill, a painful, unavoidable extraction. A punishment from Washington. But Munger taught us to view them differently. He saw the voluminous tax code not as a book of burdens, but as an incentives manual. This video is your deep dive into the Munger mindset. We are not talking about shady loopholes or complicated offshore trusts that only the mega-wealthy can access. If you are serious about tax planning for retirement and ready to adopt the simple, ruthless rationality of Charlie Munger, stick with me. Hit the subscribe button and the bell so you can join the community that plays the financial game by the rules, not by emotion. Why is Munger's perspective on this topic so profoundly important? Because Munger was a master of applied rationality. He taught that success in life, and particularly in investing, is less about achieving flashes of brilliance and far more about simply avoiding spectacular stupidity. And the number one stupid mistake people make is failing to consistently consider the tax consequences of their financial actions. Taxes are not physics. Taxes are not gravity. They are not a fixed constant. They are man-made rules, written by lawyers, full of generous incentives and odd exceptions for anyone willing to read and internalize them. Most Americans, especially those in their 40s and 50s who are serious about tax planning for retirement, treat taxes as an annual panicked chore, a frantic scramble the night before the April deadline. They treat the game like a sudden pop quiz. They play defense only, hoping to minimize the damage already done. The wealthy, however, treat taxes as an ongoing, year-round strategy. They view it like a game of chess, not a game of darts. They play offense. Think about your own time allocation. Most people spend more hours every month comparing prices at the supermarket, clip coupons, or hunting for $2 discounts online than they do analyzing their lifetime tax burden. They'll drive across town to save $2 on a gallon of gas, but they won't spend 30 minutes reading IRS publication 523 to learn how to save $25,000 on capital gains. The U.S. government, through the tax code, wants you to engage in specific, productive behaviors. It wants you to invest in long-term assets, buy a primary home, save diligently for retirement, and start a business that creates jobs. It rewards those specific behaviors with generous tax advantages. But rational behavior isn't common. And that is why these massive tax advantages end up benefiting the minority who actually pay attention and structure their lives accordingly. This is why Munger often said bluntly, if you ignore taxes, you're volunteering to be poor. You are handing money over to people who understand the system better than you do, and they will take it happily. We are going to look at the 3 biggest, most predictable financial weapons available in the U.S. tax code that you can start using today. We start with the single largest asset most people ever own, the house you live in. Most people buy a house for purely emotional reasons. They're told it's the American dream. They buy it because their parents said renting is throwing money away. All of that may be true, but it misses the entire point from a financial structure perspective. I'll tell you the real reason the wealthy treat their primary residence like a strategic financial weapon instead of a sentimental purchase. It gives you one of the most generous, predictable tax breaks ever written into law, the Section 121 exclusion. Here's the stunning deal. When you sell almost any asset, stocks, land, businesses, you pay capital gains tax on the profit. You make money, the government wants a slice. But your primary residence is very different. If you're single, the IRS lets you keep the first $250,000 of profit tax-free. If you're married filing jointly, it's a whopping $500,000, tax-free, no capital gains owed. Not a single penny. You owe nothing on that profit, provided you have lived in the home for 2 out of the last 5 years. 2 years. That's it. You don't need an army of accountants or exotic legal structures. You just need to know the rule exists and act on it. Most people, tragically, do not. The wealthy understand that the government is essentially rewarding homeowners who foster neighborhood stability and build wealth. They don't just sit on this asset, they optimize it. The unforced error Munger warned about is when the average person lives in one house for 20 or 30 years, pays interest, pays maintenance, and never once considers how to repeatedly harvest the maximum tax benefit. They treat their house like a sentimental museum, something to be emotionally attached to. The wealthy treat it like a movable financial instrument. The key here is strategic mobility. The biggest mistake is inertia, staying put because moving is seen as an inconvenience or an emotional burden. The wealthy gladly move if the math makes sense. And the math absolutely makes sense when we talk about a $500,000 tax shield. Let's look at a simple, actionable scenario a couple will call the Smiths, who are serious about tax planning for retirement and understand Munger's rationality. The Smith strategy, the Munger way. In 2015, they buy their first home for $400,000. They live in it for 3 years, spending $100,000 on smart value-add renovations that significantly boost the home's appeal. In 2018, the house sells for $750,000. Their all-in cost basis was $500,000, making the profit $250,000. Tax owed $0. They immediately roll that money into a new home. In 2019, they buy a larger home for $800,000 in a slightly better market. By 2023, that house appreciates naturally due to inflation and market dynamics to $1,300,000. They sell it. Profit, ignoring minor renovations, $500,000. Tax owed $0. In under 10 years, they've added $750,000 to their net worth, all of it tax-free, simply by using the mobility incentive. Now compare that to the average American who buys one $400,000 house, stays for 25 years, and it sells for $1 million. Total profit, $600,000. They capture the $500,000 exclusion, but that remaining $100,000 is subject to long-term capital gains tax, costing them between $20,000 and $25,000, depending on their marginal income. More importantly, they only use the exclusion once. The Munger strategist used it twice and can use it many more times before retirement. The opportunity cost is massive. If adding $250,000 to $500,000 of tax-free profit doesn't interest you, you're allergic to money. This is not about cheating the system. This is the system. The tax code is giving you a clear, unambiguous path to build wealth. Before you buy your next home or decide to stay in your current one for another 20 years, ask yourself a simple question. Am I using this asset the way the tax code explicitly intends me to? If the answer is no, you are choosing inconvenience over potentially millions of dollars in tax-free profit over your lifetime. People love to complicate investing. They chase exotic strategies. They gamble on meme stocks. They day trade like they're auditioning for a hedge fund job. Most of them lose money, of course, because they introduce friction and volatility where simplicity is required. Yet, the simplest, most reliable tool for building long-term, tax-efficient wealth has been sitting right in front of them for decades. It's called the Roth IRA, and it is one of the rare cases where the government actually rewards you for being prudent and thinking long-term. Let me explain this in the most unromantic way possible. With a Roth IRA, you pay taxes up front. The money goes in already taxed, post-tax dollars. But here is the critical part. Everything that grows inside the account, every dividend payment, every capital gain realized upon sale, every compounded dollar, comes out 100% tax-free after age 59 and a half. This is not a gimmick. It's one of the few deals in life where the government steps aside and says, "Fine, keep it all. We have no claim on your growth." If you think that's insignificant, you haven't truly understood the mathematics of long-term compounding. Most people underestimate the brutal, frictional cost of taxes on decades of wealth creation. Let's say you invest for 40 years in a standard taxable brokerage account. Every time you sell a winning stock, you owe capital gains tax. Every year you receive a dividend, you owe ordinary income tax. Every rebalance, every withdrawal, you lose a slice to the IRS. With a Roth IRA, none of that tax friction happens. Compounding is allowed to do its job without interference from the government. Tax-free compounding is the closest thing to magic the financial world offers. But here's the strange part. Most people ignore it. They say, "Well, I don't get a tax deduction this year," and they choose a traditional 401k instead, celebrating the immediate tax break. This is the kind of short-term, instant gratification thinking that keeps people financially mediocre. They trade a massive seven-figure tax-free benefit later for a small temporary tax benefit today, simply because the later benefit requires patience and a belief in the future. The world rewards long-term thinkers and punishes short-term ones. The Roth IRA is designed specifically for the long-term thinker. A Roth IRA is literally an insurance policy against your future tax burden, and it is the key piece of tax planning for retirement that provides predictability. Here's the irony most people miss. If you are successful and follow the investment principles Munger taught, you should expect your income in retirement to be high. When you retire with a large traditional portfolio, every withdrawal is taxed as ordinary income, potentially pushing you into higher tax brackets. The IRS will want a bigger share than you prefer. With a Roth IRA, that massive tax problem never arrives. Not at 60, not at 70, not at 90. Let's use a specific example. Assume an investor contributes the maximum allowable limit, currently $7,000 a year, into either account for 30 years, achieving an estimated 7% annualized return. Traditional versus Roth analysis. The total gross account value is around $760,000. If that $760,000 is in a traditional account and your combined effective tax rate in retirement is a reasonable 20%, you lose $152,000 to the IRS just to access your own money. The Roth is immediately worth $152,000 more after taxes. This calculation doesn't even fully capture the lifetime savings on dividend friction and capital gains taxes during the accumulation phase. Furthermore, the government doesn't force you to take money out of a Roth. There are no required minimum distributions, RMDs, during the original owner's lifetime. You can let the account grow for as long as you want, and you can pass it to your heirs as a clean, tax-free transfer of wealth. This makes it an incredibly powerful tool for dynastic wealth planning. Boring wealth beats exciting poverty. Most people drift toward the second option. They chase shiny objects. They skip the basics. They avoid the unglamorous, repetitive work of funding the Roth every year. If you want to avoid that fate, you don't need financial brilliance. You need patience. You need a Roth IRA and the discipline to fund it every single year. If you want to understand why wealthy people love real estate, forget the stories about market appreciation or rent checks. Real estate is attractive because the tax code treats it with a level of financial generosity that would be impossible in almost any other sector. When you own a rental property, the IRS allows you to claim that your building structure is wearing out and deteriorating over 5 years. This is the government's way of encouraging investment in housing stock. Now, here's the funny part. The building might actually be gaining value. The neighborhood improves, inflation drives replacement costs up, and demand increases. But the IRS still lets you pretend it's deteriorating. And that illusion, that polite fiction, is worth a fortune because it creates a deduction. Suppose your rental building structure is valued at $500,000, excluding the land value. Divide that by 27, 5 years. That's roughly $18,181 in depreciation deductions per year. Depreciation is just the opening act. Almost every legitimate cost associated with running a rental property is tax deductible. Property taxes, insurance, repairs, landscaping, management fees, legal fees, and, of course, mortgage interest, often the biggest piece. By the time you add up all these itemized deductions plus the large non-cash deduction from depreciation, your taxable rental income can easily fall to $0 or even a net negative, a paper loss. This is not because the property didn't generate money, it had positive cash flow, but because the tax code allows you to calculate income in a way that favors you. You are literally having positive cash flow but showing a zero or negative income to the IRS. The tax code bends in your direction like a tree leaning toward sunlight. Naturally, most people never take advantage of this. They avoid real estate because they obsess over the inconveniences, clogged toilets, and tenant phone calls. Fine, but don't complain later when you see sophisticated landlords paying far less tax than W-2 employees. It wasn't trickery. It was competence and structure. Now, let me tell you the part that separates amateurs from professionals. Depreciation isn't entirely free money forever. If you sell the property outright, the IRS will want to recapture that depreciation, taxing it as ordinary income. Most people stop here and conclude the benefit is offset by the recapture. But here's where the intelligent investor outmaneuvers the taxman, the 1031 exchange. This perfectly legal mechanism, codified in Section 1031 of the IRS Code, lets you roll your entire proceeds, including the deferred capital gains and the depreciation recapture, into a new replacement property of like kind without paying taxes. You are not eliminating the tax, you are deferring it into the future. And the future is where clever, patient people like Munger prefer to move unpleasant things. The key is that you can do this multiple times over decades, deferring the tax liability again and again. This leads to the ultimate final structure, the stepped-up basis. If you hold that real estate through decades of 1031 exchanges until you die, the asset passes to your heirs with a stepped-up basis, meaning the asset's taxable value resets to the full market value on the day of death. Let's imagine you bought a property for $300,000 and it's worth $2 million when you pass away. Your heirs inherit it as though they bought it for $2 million. If the heirs sell the property immediately, the taxable gain is zero. All the appreciation, all the lifetime capital gains, all the deferred depreciation simply vanishes from the tax system legally because the tax code explicitly allows it. You enjoyed rental income for decades, You enjoyed depreciation deductions. You enjoyed leverage. And then you exited the game tax-free. Munger quote, paraphrased, "The rich don't evade taxes. They postpone them for so long that occasionally they never pay them at all." If you really want to understand why some people accumulate wealth effortlessly while others struggle for decades, start by examining one simple difference in financial plumbing. Employees pay taxes first. Business owners pay taxes last. That one distinction, the sequence of the cash flow, explains a tremendous amount of financial inequality in the U.S. economy. Most people don't realize this. They think the rich must be doing something complicated or scandalous. No, the wealthy simply understand sequence and structure. Employees follow this sequence: earn, right arrow tax, right arrow spend. When an employee earns $1, their W-2 wage has Social Security, Medicare, and federal and state income taxes immediately withheld. They might only keep 60 or 70 cents before they buy groceries or pay rent. The government takes its cut instantly and has perfect visibility. Business owners follow this sequence: earn our right arrow, spend on legitimate business costs, right arrow tax on what's left. The reversal changes everything. They earn $1, and they get to spend that dollar on things required to operate their business, often things they would have paid for anyway if they were employees. This includes a car used to meet clients, a new computer, a dedicated phone line, business training, software subscriptions, travel, and a portion of their home office. All these legitimate business expenses are deductible, all reducing the final net income subject to tax. The tax code doesn't favor the rich as people. It favors productive activity, risk-taking, entrepreneurship, and job creation. The system is designed to reward the people who create the economic engine. The employee works for money. The business owner works for structure. And structure always wins. This doesn't mean everyone must quit their W-2 job tomorrow. It means this: if your entire financial life is built solely on a W-2 paycheck and you have no business ownership, your taxes will always be higher than they need to be because you have ceded control over the timing and nature of your expenses. The solution is an immediate structural change. Start something, anything legitimate: a consulting activity, a freelance service, an online shop, or a small operation that produces revenue. The moment you become a business owner, even in a small, legitimate way, you move from a system designed to take taxes from you to a system designed to let you control when and how you pay them. Action step 1. Just start. Form an LLC or become a sole proprietor. Begin generating revenue, however small, outside of your main job. Action step 2. Track everything. Your education that improves your business is deductible. That new laptop, instead of being bought with after-tax dollars, is now bought with pre-tax dollars, effectively making it cheaper by the amount of your marginal tax rate. Action step 3. Hire a CPA. People often object, "But I can't afford a CPA." Munger would tell you the truth: you can't afford not to. A good tax strategist or CPA is not a luxury for the wealthy. They are an essential tool to prevent the $100,000 unforced errors we've talked about. Their cost is an investment that unlocks the entire system, and, yes, their fee is a legitimate business deduction. Never be penny-wise and pound-foolish when dealing with the IRS. Finally, let's tie the three concepts: the $500,000 home exclusion, the tax-free Roth growth, and the real estate depreciation deferral into the ultimate financial structure. It's called Buy, Borrow, Die, BB&D. It sounds dramatic, but it is the zenith of Munger-style rationality. Buy. Wealthy people perpetually buy assets that appreciate: Roth-funded stocks, cash-flowing real estate, private businesses. They don't buy consumer toys that rust. Crucially, they do not sell them, because selling triggers capital gains taxes. Holding triggers compounding. Borrow. When they need cash flow or liquidity to live on, they don't sell their appreciating assets. They simply borrow against those assets. Why? A loan is not income. They pledge the growing asset as collateral, take out a loan, and get spending money without selling anything. The asset keeps compounding, and the taxes remain deferred. Die. When the owner eventually dies, the heirs inherit the assets at the stepped-up basis. This legally erases the tax liability for all the lifetime appreciation and deferred gains. The owner lived on tax-free borrowed money. The heirs pay zero tax on the gains. Buy, borrow, die isn't a trick. It's a framework, one built on patience, discipline, and respect for the power of untaxed growth. This is the final word on structure. People love to argue about fairness, but fairness doesn't make you rich. Understanding the rules and applying them pragmatically does. If this conversation moved you from playing financial defense to offense, hit the subscribe button. We dive into these types of actionable strategies every single week. Before you go, I want to ask you this. What is the biggest unforced error you've made in your personal tax planning? Did you miss the Roth opportunity? Did you stay in one house too long? Let us know in the comments below. If you want to know the specific stock market investment that Charlie Munger and Warren Buffett agree is the single most important tool for the average American outside of the Roth, watch the video linked on your screen right now. Thanks for watching, and we'll see you in the next one.